How's it going, guys? Back with you today to do another video. This topic today I want to do is about buying low and selling high. We hear that often when it comes to trading stocks. The common thing that we hear is that we want to buy low and sell high. So what does that exactly mean? As I mentioned in my previous video, that's the same thing as saying you want to buy at support and sell at resistance. So in order to pull that off, you need to know where support is and you need to know where resistance is. So here is what I'm going to do. I'm going to show you exactly how I found that out with this trade right here, which is a profitable setup, and this is actually a high probability trade, and I'm going to show you why. So we see in pre-market the price goes from $1.31 and it rises all the way up to $2.57 over here in the pre-market. So after that price rise, the price starts to go down towards the open. So this $2.57 area is going to be the pre-market high, and that's also going to be resistance. So when we put this line right here, we're going to look for the price action to go above this line in order for us to consider entering a trade on this stock. So basically at the open, we see the volume start to pick up, the price starts to rise, and it continues to rise. And then what happens once it gets back into this pre-market high area set right over here? So we can take a look. This right here is $2.58. So we see that the selling pressure starts to come in right here at resistance. So that's a very key thing to note when we're considering high probability trades. When we're trying to understand support and resistance, we see at resistance, key resistance areas set in the pre-market high, we see that the buying pressure comes in right at that resistance line, and that's not there by mistake. That's not a coincidence over here that the buying pressure, or sorry, that the selling pressure started to come in towards this line. This right here, this resistance line, is being well respected by the market, and I can say that because once the price gets to it, the market reacts, and it reacts in a way where selling pressure comes in and it pushes the price down. So once we get up to $2.58, within a 5-minute range right here, the price actually goes back down to $2.32. So that's the market. That's an indication that the market is indeed respecting the resistance line set in the pre-market high. So once the selling pressure comes in, we see that the chart continues to go sideways right here. So basically, up to this point, let's cover this up right here, and let's show this pre-market high. So up to this point right over here where the selling pressure comes in and pushes the price back down, once the price comes up to resistance, we see it going sideways. So I don't advise at any point in time all the way up to this point that anybody should be entering a trade right here. Some people might argue that we can see a hammer candle right here at the bottom of a downtrend, with volume pushing this up, and maybe you can enter that trade. For me, I was not able to enter this trade at this given point right here, because by the time I looked at it, it was like 11 a.m. or somewhere before lunch, and I had missed all this price rise over here. So basically I had no intentions on entering it, and you shouldn't enter this trade either until you see what happens at this resistance line. So the fact that the price starts to rise and then it touches this, even though selling pressure comes in, that's still very bullish, because this pre-market high price of $2.57, that's basically people are looking to trade in this area, because this is a breakout area. So once the price actually starts to come back from this low right here, let's see how low it went. So $1.55. So for the price to go from all the way from $1.55 all the way back up to $1.58, that's very bullish because even though the selling pressure came in, that shows commitment on the buying side. So basically the buying power and pressure was strong enough to take the price action all the way back up to the area of the pre-market high. So that should catch your eye right there. So if you ever see that, immediately start following this chart. And here's what you want to do when you actually identify this. You want to use a buy stop order, and basically buy stop orders allow you to set an entry price above this resistance line, because we know that if the price breaks this resistance, that it's gonna run up a little bit, and that's going to be a high probability trade. So that's all we want to trade. We want to look at for high probability trades. We don't want to guess anything. We don't want to be confused or enter on trades that are, the setups that are subpar. Whenever a price breaks above a pre-market high resistance point, that's going to be the highest probability kind of trade that you can enter. So and to prove my point, once the price actually gets back into this area, it goes sideways, and let's say you use a buy stop order and you set your price to $2.59. You want to set it about 2 cents above the pre-market high, so that way that when the price actually does break the resistance, it breaks it to the point where it's convincing. Because if it doesn't break it, right here is only a break it of 1 cent. It goes to 1 cent above the pre-market high. It goes to 258. So the pre-market high is 257. So you don't want to set your buy stop order in only 1 cent above the pre-market high. There's been times where I've done that and have made profit, but you typically want to set it like a minimum of 2 cents above, so that way the price action is convincing, and it's just more of a high probability trade when the price breaks 2 cents rather than only a cent or even half a cent. And to prove my point, we have, after the selling pressure comes in, so that's 5, 10, 15, 20, 25, 30, 35 minutes later, the price is back up to this resistance line, back up to the pre-market high. So that's very, very bullish. And if we did, let's assume we did put a buy stop order in at $2.59, we would have entered the trade right here. And what happens next? So we would have had entered the trade, let's say at $2.60. So 5 minutes after we enter, we see the price goes all the way up to $2.75. So that's 15-cent rise. That's a pretty profitable opportunity right there. That gives you an easy 2-to-1 risk-reward ratio, and that is what you want to see. That's the type of trade that you are aiming for. If you don't see a trade and it doesn't, if a trade doesn't look like this on a breakout, where you see commitment, you see the buying commitment come up and push the price all the way back up to the pre-market high area, you don't really want to look at that. So since we see that the price action's starting to come back into this area that was set right here, and we're keeping that on our radar, and we put our buy stop order in for $2.59, we enter at $2.60, the price goes up as high as $2.75. So we have an opportunity to sell on a 15-cent gain. So that's as good as it gets. That's an easy profit right there. Let's assume that you entered right here at 260 and you sold at 270. That's still a 10-cent gain, and that gives you an easy 2-to-1, and that's a very good profit right there, an easy profit. So there's a lot of stocks, a lot of patterns that people trade, and there's other different types of setups other than this, but this is an easy setup, and if you're looking to make easy money, you'll see this setup occur about 2 to 3 times a week where it's actually worth entering, and it happens often enough. So if you're following stocks during the trading hours and pre-market, and you're just keeping things in your watch list, you can see things like this all the time. So I don't really trade anything that's not a breakout pattern. Breakouts give you your high probability, because once the price breaks this line right here, that's where you get these 10-cent and 15-cent shifts, and it's just kind of like, it's instant. It's like that's 5 minutes later. So you enter here, within 5 minutes you have an opportunity to make a 10 to 15 cent pickup. So yeah, that's what's always what you want to see. That's high probability, and if you set your stop loss right over here, assuming you enter in at $2.60, you set your stop loss at 258. Let's say if the price the price action went against you, and you were wrong about the direction that you were thinking the stock was going to run to, you would have been stopped out on a 2-cent loss, and you're usually not going to get stopped out on a setup like this, because basically this is like a high probability. It's like a very, very high chance that once the resistance is broken, that the price is going to run up. So just keep that in mind. If you have any questions, feel free to comment below, and if this video is liked or helped you in any way, shape, or form, feel free to like and share. Thank you.